Welcome into this week's office hour calls, and we do it every single Wednesday at 12 p.m. Central Standard Time. This is the call where we walk through what the market is doing, what the best spots to use are, how the options bot portfolio is performing, and what is happening on the leaderboard. So, thank you so much for tuning in. This call is on Zoom for our Oat Unlimited members so that they can ask questions and get basically just clarity on anything that they need. It's also being live streamed onto YouTube for the general options auto trader community. Now, let's dive into it. We always start out with the market overview. This is where we talk about the market trend. Now, we don't just guess on market trends or make up random slopes or random lines. What we do is we use our market analysis indicator, which uses math to help us understand what trend we are in. Now, right now, we're bouncing between bullish and bearish levels. So you can see here that we broke below 6,600, which was the level we were watching out for our bearish level. We broke below it. We went down close to 6,400, around 6,500, and then we bounced back up. So now we're in between bullish and bearish levels, and this is what's called the messy middle. So what are my thoughts? You guys should be having in your portfolio in general, you should be having bullish spots and bearish spots, each that trade based on the market trend. And right now, since we're bouncing between two levels, you should have probably primarily bullish spots on, and then also have bearish spots on. And then that way that they can work together. Why? Because we're in this middle. We're bouncing between where the market is trying to judge, do we have enough bullish activity to keep the market from dropping, and vice versa? Do we have enough bearish activity to actually fully push this market down? Now, nobody in the market really wants it to drop per se. So there are some external factors that are pushing into the market to make sure it stays afloat. We can't control it. But because we're in this middle zone, it's best to have both activated. So as you'll see here, primarily I have bullish spots on right now with a couple hedges on, so that if the market turns around, my stop losses will hit on my long positions, and then my hedges will pick up the slack and recover most of those losses. And so that's what we're looking at there. Option spot portfolio. Right now, they are down because the market has been down. If time continues to work out in our favor, these will. As that meaning, if the market stays roughly where it's at right now and time moves forward, then we will make money from time decay. But as of right now, down on these trades, but we do have the hedges there as well that are activated in case the market fully drops. We'll close out a bullish automatically, and then our bearish will pick up the slack, or vice versa. We'll head higher. The bullish spots will definitely kick into some profits, and then it will offset any bearish spot losses. So allocation currently $50,000 in option spots. We have 90K in SGUB and 45K in cash. Currently in the messy middle, so we're transitioning between trends, which can be a little messy until the new trend really picks up some steam. So again, we don't really have a dedicated trend yet, but we're waiting to see which one dominates, which is why we're playing both sides at the moment, because we dip down in the bearish, push up in the bullish, things like that. Bot overview here for the top bots so far this month. This month is coming to a close, which is pretty nice. But what we see here so far on the month is Dawn winning with his 1 DTE call credit spread. Again, go copy that bot if you haven't yet. It's a fun one to have in your back pocket. Essentially, just putting on call credit spread when VIX is over a certain level, knowing that, hey, if VIX is high, the market is probably moving lower, which you think fall credit spread is the ideal play. We also have Mamuka, which is the bearish spot, the hedging bot we use inside of our options bot portfolio for Oat Unlimited members. That same bearish bot, he just activated it early, which allowed him to start making some money. And then Biweekly Rainmaker is also on that top list because, again, we're more in that messy middle neutral zone. So by selling calls and selling puts, you're able to make money both ways. We have a couple Biweekly Rainmakers. We have an ES Strangle, same thing as the Biweekly Rainmaker. All those doing well this month. And so, yeah, that's kind of what we're seeing there. Again, top odds, call credit spread, put debit spread, strangle. And then again, we should be using the full portfolio, having bullish and bearish spots. And the bearish spots are finally active, running, and protecting the accounts. So again, if something happens, we now have them there in live. So with that said, we got over the market. We're in a messy middle. We're in between our main bullish bearish. We're waiting for a trend to develop. While we are having trades for both sides is going to be advantageous for us. And then once the market picks steam in a direction, that's where we're going to cut bait on the other side and let the other one run to make those profits. So that's what we're looking at there. Now we're getting into the Q&A. I'm going to look at the Zoom chat and we're going to see what is going on from people. So let's see if we have any questions. Please put it in there. Looks like we now have more people. So welcome in Dale, Ingo, Robert, Trone, and Vera. Glad you guys are here. If you have any questions, please put them in the chat. As always, I will make up conversations and topics if you guys don't have questions. So no worries. I know some of you guys just come here to chill and learn and talk with others. But if you have a question, please put it in the chat. Trone raised his hand, maybe he has a question. I don't know if he's putting it in the chat or he wants me to unmute. Let's see if I can unmute. That was a mistake. Sorry. Okay, yeah, no worries, Trone. We can have the hands up as a way. Yeah, so we're looking at the market here. Still, we're just playing in this. You can see here we pushed through this level, that 6,600 level, which was my idea of a support level. We pushed below it, then we gapped down, and the bull stepped in. And now we're just very neutral, right? This candle and this candle, small bodies, long wicks, meaning neither the bulls or bears are in control. It's just that middle ground. We're waiting for something to happen. I assume it's primarily due to Iran. We're waiting to declare if it's all out war, if Iran's going to surrender, or whatever is going to happen again. I don't know what's best, but I think the market's really just waiting for a definite answer right now. There's a lot up in the air. And that's reflected here in the stock charts. Either way, our best play is to play both sides. Let's see here. There's a question. Robert says, my trend chart on top shows we have been in the red for 6 straight days now. Do you have an updated chart? Yeah, I don't know. Let's see. We have red. Again, the 200-day moving average for this, again, the middle of this is a 200-day moving average. So take that into consideration. So if I come here, looks like 6,661 is the 200-day moving average. So I don't know where your 200-day moving average is, but that would help put into perspective where yours is at. So that middle line is the 200-day moving average. If it's near 6,661, that would put you in accurate levels with what we're seeing here. If not, I'll see if I can look through that old code on TOS and see if I can get you an updated version. It may be outdated, but I haven't changed the settings here. They've been the same for the last years. Sweet. Let's see. Okay, let's see another one. Robert said, look at your TOS version. Yeah, I don't have TOS charts anymore, but I can pull it up and see. I don't have TOS downloaded on this computer, so it's not something I could go check out. After they switched to Charles Schwab, I haven't really used it. But yeah, so this middle line is a 200-day moving average. This is 2 standard deviations, and this is 3. So again, most of the market will always stay within a 2 standard deviation move, which means if we move outside of it, that's the rejection points. So again, if you're also long-term investing like I am into like SPY or some mutual fund or however it is, a great way to get a good entry point is to wait for to use this indicator and wait for the market to drop into either, again, you can sell on the red point if you want, but also dips into this green zone. That's like dip buying perfection. This is ideally where you dip buy. That's what I've done over the last couple of years. Every time the markets dip below here, I took all cash that I have available and I put it in the market that way. I'm getting into the market at a very extremely profitable level. So now you can see here across time, instead of dollar cost averaging, which yes, is a great approach, which just over time you enter, right? If you entered from this point here, to dollar cost average, your average price would be what? Here's your start, here's the end. Your average price would be here. And so you can see it because I entered here and here, my average price that I entered is actually here. So what is that a percentage? I got an extra 16% compared to others. So again, not bad. You can see here from the lows to the highs, right? 73%. So that's one way to use this band in another form. If you're not just going to use it you can use it for swing trading. Obviously, well, we use it as, but yeah, that's one way as well. Any messages in the chat? No. All right. Maybe just a chill day. Yeah. Let's go. I'll shoot you a quick lesson and then we'll call it a day unless there's a chat. Remember, risk management is key. Always understanding how much you're okay with risking at any given point is the ideal play when it comes to options. And so the way that we calculate that is we calculate 30 to 40% based on So how much buying power we should use is based on 30 to 40% of the account. So for easy numbers, we have a 100K account and we want to use 40% of our funds. Again, 30% is what you'll use if you're low risk, 40% medium risk, 50% higher risk. So 40,000 should actively be in trades. But just because we want to put $40,000 in active trades doesn't mean we're okay with risking $40,000, right? With this, we may have to put up more money than our risk actually is, which is the case for a lot of the futures options trades we do. For instance, a 111 trade, you put up 7 grand, but your risk is about 3 to 4 grand, depending on your stop loss, right? And so understanding, okay, this buying power can give me X number of trades. Let's say it's 10 trades. If it's 10 trades, I have to understand based on the stop loss level that I use, what is my loss per trade? Let's say it's 2 grand, right? 2K. If I have 10 trades open, that means my max risk is 20K. Okay, you have to know this number. What is my max risk if all my trades hit the stop loss? If you know this number and you're okay with this number, then good. You're trading the right amount of money. Now, if you look at 20K and you're like, that would be a tough hit, then what you want to do is you're like, okay, what would be an acceptable hit? Maybe $10,000 is an acceptable hit. If so, that means we need to drop this down to a 5 position size instead of 10. So make sure you always know, hey, based on the amount of money I'm trading with, these are how many trades that will go off. Based on my average loss per trade, this is what the total loss would be if all my trades hit loser. And am I okay with that amount? So that's one thing. Number two is understanding it with time and direction. So option sellers make money from two different ways, and that is either from time or from direction. There's a Q&A. I want to make sure I get to it. Seems like SPY is driven by crude prices, and crude is being actively driven by war news, which changes throughout the day. Exactly. Yeah. Like I mentioned, this whole neutral market is all due to war news. We don't know what exactly is happening. There's no conclusive decision from the United States of like full out war, like we're going to ship people in, or Iran is like, yeah, we're going to war too, or they're like, actually, we'll give up. We don't know because we don't know because there's so much things going on. We're in that neutral, messy middle, which is really impacting the market. But yeah, so coming back to option prices, when we're option sellers, we're making money on two different methods. We're either making money from time or direction. Now, most of you guys, for most of your trading history, have made money on direction. You take a bullish strategy, the market goes up, and so you're able to close a trade in 7 days for your take profit. That is direction. Direction is the fastest way to make money as an option seller. You were right on the direction and it made you money. The next one is T for time. Now we have this thing called theta decay in option selling, but that takes time. It takes anywhere from 30 days to 60 to 90 days to actually profit when direction's not in your favor. So if the market is still above your strike prices, which for most of you, they are, you will be seeing a negative loss right now. But what you're playing on at this moment is time. As long as the market stays above your strike price and is doing its neutral, messy middle thing, then you're going to make money from time as long as you let time play out. So those are two things to be aware of. I mentioned risk first because you want to make sure you're okay with your risk. As long as your risk is in check, then give it as much time as you need, and you should be good to go. So just covering some of that again. Yeah, so let's pull up crude oil real fast, CL crude oil futures. So let me take away this. Move 11 drawings. Yeah, so we had obviously the Iran deal spike to this. So we had the Strait of Hormuz and all this other stuff that we're having issues with shipping and whatnot. But you can see here, it jumped from about $65 per barrel or whatever, if this is measuring, all the way up to a high of 120. So it literally doubles, which is insane. We're now at 90. We're starting to fluctuate. Obviously, this indicator still plays out the exact same. It does that every time, right? When we're in these extreme levels, we can stay there for a bit. Like you can see here, we're in the red. We can stay here for a little bit, but we are overextended. It's going to pull back to a natural medium around $65 in the next few months. Again, we don't know what can happen, right? We can look back at history and look at over different war periods and war times. We can see here 2007, 2008 is that like crash you can see here. Crude oil definitely picked up. What are other war periods that we had? I don't think I can go back far enough. Yeah, dinosaur land. Far enough to see like the Great Depression or like World War II. I don't really pick up on that if they go that back. But I would be curious to know how crude oil prices perform during war periods like that. But for now, yeah, we are high, but we'll probably come down on something certain. Is it wise to use futures in the bearish spot? It really depends on how you want to run it. I personally don't. The reason being is because when it comes to bearish, that means the market's dropping. And so that means buying power can really be expanding. And I really don't want the buying power of my protection bot, my hedge, to change. So I'm going to use something like SPY or maybe SPX. So I want to be bigger slash tax advantage that I would use to either buy the put or do a put and debit spread so that I know my buying power isn't capped. Like it's at the amount it's going to be, and it's not going to change, which futures would. So, like for instance, if I get into a hedge on futures, I'm like, cool, I got in for $500. I'm protecting $5,000. That's what I'm going to make if the market drops. That's awesome. But then the market starts dropping, and now you're like, dang, I'm losing money on my bullish spots, and now I need $2,000 more to keep this bearish position open because the futures buying power increased. And so, again, that's just a personal preference. You're more than welcome to do your bearish spot on futures, but that's my logic and explanation for why I do it on SPX and SPY instead. That's just me. Great question, though. Awesome. Any other final questions in the chat? We got a good number of people here. We have Trone, Bobby, Dale, Inga, Keelan, Robert, and Vera. We see here Vera. How do you hedge bearish bot using SPX against ES futures? Yeah, so they're the same asset underlying. So like they're all tracking the S&P 500. So I have ES futures for the bullish, and then we're going to move the exact same. We're just taking advantage of it in SPX instead of ES futures. So it's still a put debit spread just on SPX. For the most part, it covers the same amount as in the prices between ES and SPX are the same, and they check the same assets. So I don't know if that fully answered that question, but yeah, you can use SPX to offset ES bullish bonds. All right. Sweet. I'm gonna wait and give it a second, see if anyone else is typing. I want to give them a time to get their question in. But for now, just to recap, market is in the messy middle. We're bouncing between our bullish and bearish levels. The bearish bots are doing fine. Keep them on, keep them running, especially when you enter bearish territory. It's okay to put on a bearish hedge. A bearish position is meant to be there for a hedge. You're going to keep it on. Make sure the cost is something you're okay with losing either way. That's why these bearish bots that we structure, their cost about $300 to $500. So we know that's a known loss, but it gives us like 2,000 to 5,000 worth of protection, which again, depending on your trade, would cover most losses. And yeah, that's how we run it. We'll wait for the market to pick a trend once it's clear where the market's going, either upwards or downwards, which again is determined by either making a new high or a new low. And then we can cut bait on the other side and continue with either bearish or continue with bullish. Okay. Looks like no other questions came up. So thank you guys so much. If anything comes up throughout the week, feel free to use Discord. Feel free to email me. I'm here. We would love to help you guys. That's the market overview. That's the top options bots. Again, you guys are doing great. We're going to end March here soon, which means the options dollar trader portfolio review, where I look at your account, I see what's going on, make sure it's aligned with your goals, see if there's anything off in the account. That report that I sent to you via email will get sent out on the 1st of April, not April Fools, like I'm going to actually send it. It gets sent on the 1st of every month. So yeah, that will be sent in. Otherwise, if you have any questions, feel free to reach out. But thank you guys so much. Glad you guys are here. Trone, Dale, Galen, Robert, and Vera. See you guys soon. Happy trading, and see you guys next week.